Have you ever watched a stock ticker scroll by, those numbers flickering up and down in green and red, and wondered what invisible hand is actually setting those prices? Is it a powerful CEO in a corner office? A supercomputer on Wall Street? The truth is both simpler and far more complex. The price of a single share of a company is a moment-by-moment consensus, a constantly shifting story told in dollars and cents. It is the clearest, most brutal, and most real-time assessment of a company's perceived value that exists. For a beginner, it can seem like random noise or a game rigged for experts. But pull back the curtain and you'll find a magnificent decentralized machine powered by two primal forces: fear and greed, or more accurately, supply and demand. This isn't just about finance. It's about human psychology, global news, mathematical models, and cold hard cash, all colliding in a digital arena. By the end of our time together, you won't just see numbers, you'll see the story behind them. Let's start with the absolute non-negotiable bedrock. Every stock price you see, from Apple to a tiny biotech startup, is determined by a continuous auction. Imagine the world's fastest, most high-stakes farmers market. On one side, you have people holding apples. These are the shareholders with stock to sell. On the other, you have people with money who want to buy those apples. The price isn't printed on a sign by the farmer. It's discovered through the shouting of the crowd. If a storm is coming and people are desperate for apples, they'll start offering more money. The sellers, seeing this frenzy, will hold out for a higher price. The price rises. If news spreads that this year's apple crop is the biggest in history, suddenly everyone is trying to sell. Buyers, knowing there's plenty to go around, will lowball their offers. Sellers, getting nervous their apples will rot, start accepting less. The price falls. This is the stock market in its purest form. It is not a single entity setting value. It is the collective action of every participant, from the pension fund moving billions to the individual investor buying a few shares in their retirement account. That last agreed upon price between a willing buyer and a willing seller. That's the number on your screen. But this simple auction is driven by deeper currents. Why does demand spike or collapse? What makes a buyer desperate or a seller panicked? To understand that, we must move from the marketplace to the boardroom and the global news cycle. The first and most fundamental driver is a company's financial performance and future potential. This is the world of fundamentals. Investors are, in theory, buying a tiny piece of a company's future profits, so they obsess over the metrics that predict those profits. Earnings reports are the quarterly report cards that send seismic waves through a stock's price. When a company like Tesla reports earnings that beat Wall Street's expectations, it signals the business is stronger and growing faster than people thought. That makes each tiny piece of its future profits more valuable. Demand surges, buyers outnumber sellers, and the price jumps, sometimes in seconds after the news hits. Conversely, a miss on earnings or a gloomy forecast from management is a red alert. It suggests future profits may shrink. The perceived value of each share drops. Sellers rush for the exits, and the price tumbles. But it's not just about profit today, it's about profit tomorrow. This is where growth potential comes in. A company like Amazon traded for years with minimal profits because investors were paying for its staggering growth potential and its future dominance. They were valuing the story, the market share, the revolutionary logistics network, the future profits they believed were inevitable. A pharmaceutical company with no revenue can have a soaring stock price because of the potential multi-billion-dollar drug in its pipeline. The market is always discounting the future into today's price. This is why stock prices can move wildly on rumors, patent approvals, or the signing of a single big contract. It's the market's best guess at what all of tomorrow's news is worth today. If fundamentals are the engine, then market sentiment and investor psychology are the volatile fuel, and sometimes the unpredictable driver who grabs the wheel. The market is not a cold, rational calculator. It is a living, breathing organism made of millions of people, each with their own emotions, biases, and herd instincts. This is the domain of fear and greed, of bubbles and crashes. Sentiment can overpower fundamentals for months, even years. Think of a hot sector like artificial intelligence stocks in recent years. The greed instinct takes over. The fear of missing out, FOMO, drives investors to buy, not because they've crunched the numbers on a particular company, but because everyone else is buying and prices are going up. This buying begets more buying, inflating a bubble where prices disconnect from any reasonable fundamental value. The opposite is pure, unadulterated fear. During a market crisis or a scandal surrounding a company, panic selling ensues. It doesn't matter if the company's long-term fundamentals are still sound. The dominant emotion is to preserve capital, to get out at any price before it goes lower. This herd mentality can crush a stock far below what its assets and earnings would suggest it's worth. This psychological layer is why legendary investor Warren Buffett famously advised, "Be fearful when others are greedy, and greedy when others are fearful." He understands that the market's mood swings create the mispricings that savvy investors exploit. The price on your screen, therefore, is not just a value. It is a snapshot of the collective emotional state of investors toward that company at that precise millisecond. Zooming out from individual psychology, we enter the realm of macro forces, the tides that lift or sink all boats, regardless of how well each boat is built. These are broad economic and geopolitical factors that shape the environment for every company. Interest rates set by institutions like the Federal Reserve are perhaps the single most powerful macro price setter. Here's why. When interest rates are low, money is cheap to borrow. This encourages business investment and consumer spending. It also makes the fixed returns from bonds and savings accounts less attractive, pushing investors to seek higher returns in the stock market. This flood of new money increases demand for stocks, pushing prices up across the board. When rates rise, the opposite happens. Borrowing costs increase, which can slow the economy and hurt corporate profits. Suddenly, safe government bonds start offering a decent return with no risk, pulling money out of the risky stock market. This broad decrease in demand leads to lower prices. Then there's the overall health of the economy. Strong job growth, rising consumer confidence, and healthy manufacturing data suggest businesses will thrive. This bullish sentiment boosts the market. Recession fears, high inflation that erodes consumer purchasing power, or weak economic data create a cloud of pessimism that dampens prices. Geopolitical events, wars, trade disputes, elections create uncertainty. The market hates uncertainty more than it hates bad news. Uncertainty leads to risk aversion, a pulling back from investments, and lower stock prices. So a company could be executing its business plan perfectly, but if it operates in a country that just entered a trade war or during a period of sharply rising interest rates, its stock price may struggle. It's fighting against a powerful tide. Now, let's meet the new giants in the auction house, the algorithms. Over the last 2 decades, the stock market has been fundamentally transformed by high-frequency trading, HFT, and quantitative funds. These are not investors making decisions based on earnings reports or economic trends. These are computer programs executing complex mathematical strategies at speeds incomprehensible to humans. They can react to a news headline and execute thousands of trades in the time it takes you to blink. What do they trade on? Minute price discrepancies between different exchanges, tiny arbitrage opportunities, statistical patterns, and momentum signals. Their presence adds enormous liquidity, meaning it's easier to buy and sell shares quickly, which generally makes the market more efficient. However, they can also amplify volatility. A sell-off triggered by human fear can be accelerated exponentially by algorithms programmed to sell as prices fall, creating flash crashes where billions in value vanish in minutes only to partially rebound just as fast. Furthermore, the rise of passive investing through index funds and ETFs has created a new dynamic. Trillions of dollars now flow automatically into the broad market based on rules, not company-specific analysis. This can lead to a phenomenon where all stocks in an index rise or fall together, sometimes propping up weak companies or dragging down strong ones simply because they are part of the basket. The modern stock price is thus a hybrid creation, part human judgment on value, part algorithmic reaction to patterns and speed, and part mechanical flow of passive capital. All of these forces, the auction, the fundamentals, the psychology, the macro tides, and the algorithms, converge on the actual mechanics of the trading venue. This is where the rubber meets the road. In the past, this happened on a physical trading floor like the New York Stock Exchange, with traders shouting orders. Today, over 99% of trading happens electronically across a network of exchanges and dark pools. When you place an order to buy a stock, you are entering this digital ecosystem. Your broker sends your order to an exchange. On the exchange's order book, every buy wish, a bid, and every sell wish and ask is listed. The highest price anyone is currently willing to pay is the bid. The lowest price anyone is currently willing to accept is the ask. The difference between them is the spread. A liquid popular stock like Microsoft will have a spread of just a penny, with thousands of shares available at each price. In a liquid, small company stock might have a spread of 25 cents or more. When your buy order comes in at or above the current ask price, it matches with a sell order and a trade is executed. That new trade price is instantly broadcast to the world as the latest stock price. This happens millions of times per second across the globe. Market makers, specialized firms obligated to provide liquidity, are constantly posting both bids and asks, earning the spread and ensuring there is almost always someone to buy when you want to sell and vice versa. Their activity smooths out trading, but is also a profit-driven business that influences the tiny micro movements of price. Finally, we must confront the murky but powerful world of information and misinformation. In the digital age, news, analysis, rumors, and hype travel at light speed. A single tweet from an influential figure, a trending post on a forum like Reddit's Wall Street Bets, or a speculative article from a financial blog can move markets. The GameStop saga of 2021 was the ultimate example of narrative and collective action directly determining price, completely detached from the company's dismal fundamentals. Retail investors coordinating online created such overwhelming demand that they forced a short squeeze, catapulting the stock price to astronomical levels and inflicting massive losses on professional hedge funds. This event proved that while fundamentals anchor long-term value, in the short term, a powerful enough story, fueled by social media and a shared mission, can become a self-fulfilling prophecy. Analysts' reports and ratings from major banks also hold significant sway. An upgrade from hold to buy by a prestigious firm can trigger automatic buying from funds that follow their advice, pushing the price up. Conversely, a downgrade or a price target cut can unleash a wave of selling. The modern investor is bombarded with a fire hose of information, and the market's price is a reflection of which pieces of information the collective has decided in that moment to believe and act upon. So, what is the answer to our original question? How is a stock price set? It is set by a dynamic, multi-layered, and often chaotic system. It is the meeting point of a company's tangible book value and its intangible growth story. It is a voting machine in the short term, as legendary investor Ben Graham said, but a weighing machine in the long term, eventually reflecting the true substance of the business. It is a number swayed by the cold calculus of interest rates and the hot passion of a social media mob. It is a consensus forged by humans, executed by machines, and disseminated to the world in a blink. For you, the beginner, this knowledge is power. It demystifies the ticker. When you see a stock move, you can now ask a series of structured questions. Was it an earnings surprise? Is there a shift in Fed policy? Is this sector overheating with speculative greed? Is the stock illiquid causing big swings on small news? You move from seeing random noise to reading a rich narrative. Most importantly, it clarifies your own role. You are not a passive observer of prices. When you choose to invest, you are casting your own vote. You are adding your own tiny fragment of demand to the auction, based on your own analysis of fundamentals, your own read of sentiment, and your own tolerance for risk. You become part of the very mechanism that sets the price. The stock market is not a remote entity to be watched. It is a conversation in which you can choose to participate, armed with the understanding of how its ever-changing story gets written, one trade at a time. Thanks for watching. If you found this breakdown useful, don't forget to hit that like button, share it with a friend, and subscribe for more deep dives made simple. Drop your thoughts in the comments. I'd love to hear your take. See you in the next one.